What is GDP? Gross Domestic Product. Many times to assess the health of an economy, GDP is considered as an important factor. Also, GDP is considered as an important indicator for long-term stock market outlook. Let us see in this video what is GDP and how it is calculated and what is its implication. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decision. GDP, gross domestic product, it is a monetary measure of the market value of all final goods, all finished goods and services produced in a specific time period by countries. What is India's GDP? India, within the boundaries of India, in one particular financial year, how much finished goods and services are produced? That valuation, that value is the measure for GDP. Right. Total monetary or market worth of all completed products and services produced inside a country's boundaries in a certain time period. In shortly, it gives the snapshot of our economy. Right. So this includes the products like finished goods and capital products. It can be electronic items, it can be services, it can be like biscuits, it can be toys, it can be medicines, it can be export, it can be clothes. It includes all these things. In addition to this, there are some exclusions. What needs to be excluded from GDP? Right? Import has to be excluded, and also intermediate products has to be excluded. When you are, if a company is producing a wrapper for a chocolate, that should not be included. Chocolates produced by the company, which is the end product, right? It includes the wrapper production cost also. So that way it is not necessary to account both. So we can avoid intermediate products. We have to take only the finished products. Also second-hand products can be avoided. How does GDP value? Yes, it is definitely a complicated calculation. Let me try to simplify it as far as possible for all our viewers. There are three methods by which GDP is calculated. One is income valuation, second is expenditure valuation, third is output valuation. In the income valuation, we take all the income of all factors of production within a country. Means the entire revenue of factors of production. Formula wise, net national income plus depreciation plus NFFI. This is the factor cost of GDP as per income valuation method. There is something called a market cost of GDP as per income valuation method. First, let us calculate GDP as per factor cost. Then it will be easier for us to calculate GDP at market cost. There are three components, right? Net national income plus depreciation plus NFFI. I'll explain one by one. Net national income includes the rewards for all the factors of production: land, labor, capital, management. Right? For labor, you have got wages or salary. For land, you have got a rent or lease income. For capital, you have got interest. For management, you have got profits. Right? Then a sum of all these four incomes for all the factors of production is what known as net national income. This is the first component of GDP as per income valuation method. Second is depreciation. Depreciation has to be added. Third is NFFI, net foreign factor income. Net foreign factor income is nothing but income earned by rest of the world, by our country, right? So income earned by rest of the world in our country. From that, deduct income earned by our country in rest of the world. When you do this, you will get a net factor, that is what known as net foreign factor income. Now you have to add all these three: net national income, depreciation plus NFFI put together constitutes GDP factor cost as per income valuation method. There is something else we have to do, two adjustments we have to do to GDP factor cost to make it GDP market cost. GDP factor cost plus indirect taxes minus subsidies makes it GDP at market cost. This is basically GDP at the production level. GDP at the market level includes indirect taxes. We have to reduce the subsidies as well. For example, electricity production may be higher at the production cost, but because of the subsidies, the market cost is low. So that is the difference between the factor cost and the market cost. Expenditure valuation. This is the total amount spent on goods and services by all entities inside a country's domestic limits. This is the second method of calculating GDP expenditure valuation. So total amount spent by everyone, it can be individual, it can be company, it can be government, on goods and services within India is known as expenditure valuation method. What is the formula? Consumption plus investment plus government expenditure plus exports minus imports. Let us see them in detail. Consumption is money spent on buying goods and services by individuals. Then investment, money invested totally. Then government expenditure, government spends money for the welfare of people. You have to add exports and minus imports. When you do that, you will get GDP at expenditure valuation you will be getting. Third is output valuation method. This is the third method. What's the total output based on the market value is what we have to take into account, because market value and the actual constant value can be different. Because of the rise in price, may look like GDP has gone up because of the inflation factor. To adjust that is what we have arrived at output valuation method. The formula for the output valuation method is GDP as per output method, then like GDP, real GDP, GDP at constant prices minus taxes plus subsidies. This is the total output valuation method GDP calculation. Now, there are so many ways of calculating GDP, and GDP seems to be a complex number. Can GDP be accurate? Because when we are taking a lot of inference, insight, decision based on the GDP number, it should be like a reliable number. It should be a credible number. So on what basis we are deciding GDP? Based on GDP, there are many things which we decide. So if the GDP number is growing, we may think the health of the economy is good. Because the GDP number is going down, we may think the health of the country is not good. The GDP is one of the important indicator to decide the outlook of the long-term stock market performance. So when we take a decision based on GDP, we have to understand what are all the disadvantages. So when next time when you see GDP, you have to understand the GDP number is not the exact or accurate number. It has got its own flaws. Let me explain the disadvantages one by one. This does not include the unaccounted income that happens. All right, there are many cash transactions, like some businesses have the practice to account only 50% of their income, or 30% of their income, or 70% of their income. So rest of the portion is not accounted. So that production is not part of the calculated GDP. Natural disaster will induce the economy, so government will relax many of its norms, and because of that, GDP will temporarily will go up. But it is basically because of the boosting measures given by the government. Because of natural disaster followed by boosting subsidies given by the government, And because of that, if the GDP is going up, we can't take it as a real GDP growth, or we can't take it as a real economic growth. When you are deciding health of the economy based on the GDP, we can't say it is a firm growth. It is because of the temporary relaxation given by the government. And the non-market factor uh, production is not measured. It's not taken into account. Say, for example, if I am producing my own food, if I am cooking my own food, if I am growing my own like vegetables, in that case, I will not buy to that extent vegetables. I will not order foods from outside because I am growing vegetables. I am also cooking. If I am not growing vegetables, I am also not cooking, then I have to order food from outside. So when I order from outside, that production is accounted. If I am producing on my own, that is not accounted. The efforts and contributions of volunteers are not accounted because GDP measures based on income and expenses. But volunteers' efforts and their contributions are not accounted in monetary terms, but it results in production. So goods and services produced because of voluntary work is not considered as part of GDP. A lot of calculation complexities, though I have explained three methods, all the three methods are not very accurate, and it includes a tedious calculation, right? And the changes in quality is also not considered. If a smart watch is produced with added quality and the price is higher than the last year model price, is it because of inflation rate went up, or is it because of the quality went up? It is difficult to judge, right? So why a school is charging more fees? Is it because they have appointed a new technology and a new method of teaching, so quality has gone up, or just because of inflation they are increasing the rate? We don't know. So changes in quality is not actually factored in GDP calculation. So these are the disadvantages of GDP. So when you are looking at the GDP number next time, make sure you are also considering the disadvantages and the different valuation methods. Based on that, you take the real calculation. Based on that, you have to arrive at a real insight, right? When you are taking the insights, observations from GDP, take a holistic view. If you have any questions on GDP or the connection between the GDP and the stock market outlook, or if you have questions on wealth creation or achieving your financial goals, feel free to book a complimentary appointment with our certified financial planners. You can have a one-on-one discussion with our certified financial planners. The registration link to book the free appointment is given below this video in the description box. We regularly organize insightful, enlightening investment webinars with investment experts. They will talk on investment strategies, wealth creation techniques, wealth management tips. It's completely mind-blowing. If you want to participate in our upcoming investment webinar, feel free to leave your name and email ID in the another link given in the description box. We will send you the invite for the next insightful investment webinar, and please make a note, it is completely a complimentary webinar for you. Hope you like this video. I'll meet you in the next video shortly. Thank you. Bye-bye.